We all desire getting the most mileage out of our stock holdings as they appreciate in value over time. However, there comes a point at which the prudent course of action is to take money off of the table and cash in your holdings. In doing so, your paper profits now become realized gains that can be reinvested in the next market leader or best-of-breed business. Holding the stocks of major retailers poses some additional challenges. So what are the signals that would allow you to wind out of a position and capture those paper profits? To help you decide, here are 5 stock investment tips for those retail businesses that you might be holding in your portfolio. Number 1, be cautious about retailers who have grown to a point of saturating the market nationally with stores in every major center. Mature retailers could start to experience a decline in sales once the market is saturated. The best time to own retailers is when they are early in their growth cycle of going from a regional powerhouse to a national brand name company. Number 2, being behind an upcoming fad can be initially lucrative for the stock investor who has taken the time to monitor upcoming trends in the marketplace. However, once the supply for a particular product catches up to the demand, your potential for increased stock price appreciation may begin to fade away. To get a better feeling as to what the market is doing, check out the conference calls of the retailers that sell these products. If they mention that they have enough product to meet the immediate and future demand, it may be time to start unloading the stock before it drops. Number 3, be vigilant each week to see if the competition has increased their share of the market and are now making a similar product for less with lower margins. Never underestimate the power of the competition to hurt your stock. When your stock's quarterly sales growth figures start to drop off and you hear about new competition in the news, it may be time to move into another opportunity. Number 4, when management is vague about the numbers on the company conference call, it usually signals a top has arrived. By doing your due diligence in listening to all company interviews and reading articles about the company's prospects, you will be better equipped to assess whether or not management is in trouble. Look for a situation where you no longer are told about the consistent predictability of the company's bottom line. And number 5, watch for frenetic store openings and office expansions that strain a young retailer's resources. How do you spot an overexpansion through either takeovers or too many new stores? Check out the company's most recent balance sheet for the long-term debt, which can be found online on most financial websites that report on the stock market. As a rule of thumb, if the company is unable to pay off this debt within 3 years from its current net income or free cash flow, they may be in trouble should problems arise in the economy. Too much debt will erode growth and your potential to capitalize on this with your stock holding. There you have it, several great tips to help you profit from those retailers in your stock portfolio. To your ongoing success as an investor,